You know, in the world of finance, promises worth literally hundreds of trillions of dollars get made every single day. But what happens if one of the big players can't keep their end of the deal? What happens when they default? Well, the answer could set off a chain reaction that rocks the entire global system. To stop that from happening, the financial world built a safeguard. And that's what we're going to dive into.
So today we are breaking down the one piece of financial plumbing designed to prevent that exact catastrophe, the Central Clearinghouse, or CCP. You can think of this as the story of how the financial world tried to build a firewall against its own collapse.
All right, here's our game plan. First, we're going to look at the tangled mess of risk that existed before the 2008 crisis. Then, we'll check out the centralized solution that was put in place. After that, we'll get into the nuts and bolts of how clearing actually works, uncover the new liquidity squeeze this all created, and finally, look at what a super concentrated future means for the stability of the whole system.
To really get why these clearinghouses are so vital, we got to rewind the clock. Before the financial crisis, the market for these really complex financial products, we're talking over-the-counter derivatives, was basically a maze of hidden risk.
And this image right here, this shows the problem perfectly. This top panel is what we call bilateral clearing. Just look at it. Every firm had separate deals with dozens of other firms. It was this tangled, messy web where nobody, and I mean nobody, could see the full picture of their own risk, let alone the risk to the entire system.
And right at the center of that web was this huge danger, counterparty risk. The fear wasn't just that the firm you were trading with would go bust. No, the real terror was that their failure would start a domino effect, a cascade that could take down perfectly healthy firms and just freeze the entire market.
And then, of course, 2008 happened, and that danger became painfully real. In the aftermath, leaders from the G20 countries knew something had to change, big time. They basically decided to rewire the whole system with a new, centralized approach. The solution is actually pretty elegant, and it's captured perfectly in this quote from the Chicago Fed. A central counterparty, or CCP, literally steps into the middle of every single trade. It becomes the ultimate buyer and the ultimate seller. It's the guarantor. And boom, look at the difference. Instead of that tangled spaghetti bowl of risk, you now have this clean hub-and-spoke model. Every trade gets funneled through the CCP. It acts like a financial firewall, simplifying everything and, most importantly, containing a default before it can spread like wildfire. And this shift happened incredibly fast. I mean, think about it. In 2007, before the crisis, less than a quarter of these key derivatives were cleared. Just 2 years later, the G20 makes it mandatory. And by 2018, that number had tripled to over 75%. A massive change in a very short time. You can see that incredible shift right here on this chart. Just look at that red line shoot straight up after 2008. Now, this wasn't just new rules forcing people's hands, it was also a flight to safety. Traders and big institutions were scrambling for the security that these CCPs offered. The system was fundamentally rewired almost overnight.
Okay, so we've got these firewalls, but how do they actually work? How does a single entity guarantee trillions of dollars in trades every single day? Well, they do it with a really important financial tool called margin. Margin is basically the financial cushion that makes this entire system work. The best way to think about it is like a security deposit. Before you can even place a trade, the CCP makes you hand over high-quality collateral. We're talking cash or something very similar. This buffer is the first line of defense, making sure that if someone defaults, the money to cover the mess is already there.
Now, it basically breaks down into two main types. You've got variation margin, which you can think of as covering today's risk. It's collected every day to square up any gains or losses from the market moving around. Then you have initial margin. This is about tomorrow's risk. It's a much bigger chunk of collateral collected up front, designed to protect against big future losses if a firm totally collapses.
But here is where the story takes a twist, because in the process of solving this massive problem of counterparty risk, the new system accidentally created a whole new and very powerful challenge for the market.
This slide really gets to the heart of the great trade-off in our modern financial system. Central clearing does an amazing job of mitigating credit risk, that whole domino effect thing. But because it all runs on margin, it creates a ton of liquidity risk, this constant massive demand for cash to post as collateral.
And this is where things get really tricky. It leads to this dangerous feedback loop called pro-cyclicality. So imagine a crisis hits. Markets are going crazy, right? Well, that volatility makes the CCP's risk models scream for more margin. So they make margin calls, forcing banks to cough up billions in cash at the exact moment when cash is the hardest thing in the world to find. The system's own defense mechanism can actually pour gasoline on the fire.
So all of this has led to another huge change in how the market is structured. By solving one problem, we've ended up with a system that's incredibly concentrated, resting on just a handful of massive pillars.
Let's just break down what the world looks like today. In the US, just 6, that's right, 6 central counterparties handle all the most important markets. 5 of those are so critical they're officially labeled systemically important. And who are their main customers? The biggest global banks. So what you have is this tiny, highly concentrated, and deeply interconnected ecosystem.
And this chart, wow, this chart really tells the story. That gold line soaring upwards, that's the amount of customer money and clearing. It's gone through the roof. But now look at the blue line, going in the exact opposite direction. That's the number of firms actually providing clearing services. It's plummeted. So way more risk is being handled by way fewer players. And the scale of this growth is just staggering. Between 2007 and 2023, client assets held by these clearing firms shot up by 240%. That explosion in assets is now being managed by a much smaller and more concentrated group of firms.
And this brings us to the pretty stark reality of the situation. You don't have to take my word for it. The Federal Reserve Board themselves put it bluntly. Because the whole system is now built around these few giants, their failure is completely unthinkable. They have to be, as the saying goes, bulletproof. The failure of just one of them would be, and I quote, a devastating event.
So I guess that leaves us with the big question for the future, right? We built these massive financial firewalls to stop a repeat of the last crisis. But in doing that, we've created these powerful new risks around liquidity and concentration. So are we really prepared to handle those risks when the next crisis hits?
This is not financial advice.